Hey everyone, and welcome back. Today, we're going to be taking a deep dive into the world of life assurance and investment.
Oh, yeah.
Something that I'm sure has crossed all of our minds at some point,
Totally.
especially as we get older.
Right.
So, to guide us on this journey, we're using Chapter 10 of Personal Finance and Investments by Keith Redhead.
Excellent choice.
It's a great book, really insightful.
Yeah.
So yeah, consider this your crash course on, really understanding these options.
I think what's really fascinating about this topic is how it gets you thinking about the value of your future earnings. What economists call human capital.
Okay, human capital.
Yeah.
That sounds kind of intimidating.
It sounds a bit jargony, but
Yeah.
it's a really simple concept.
But when I think about it, I guess it's true. My ability to work and earn is like my biggest asset,
Yeah, especially when you're younger.
especially now.
That's when your human capital is at its peak.
Yeah.
You've got so much earning potential ahead of you,
Okay.
so it makes sense to protect it.
That's where life assurance comes in, right?
Exactly.
It's like a safety net.
It is. It's a way to protect your loved ones financially.
If, God forbid, something were to happen to me.
Yeah, it's providing for your family even when you're not there anymore.
Wow, I see why Redhead emphasizes this, especially
Wow.
for, us younger folks.
It's a crucial part of financial planning, but it often gets overlooked.
Yeah, for sure.
And it's not just about life assurance either. Redhead also talks about permanent health insurance,
Okay.
which protects your income if you become too ill to work.
So like income insurance.
Exactly. Think of it as income insurance, another way to safeguard that human capital we were talking about.
Wow, that's really interesting. I never thought about my ability to earn as something I needed to protect,
Right.
like a house or a car or something.
Yeah. It's easy to overlook because it's not a physical asset,
Yeah.
but it's arguably your most valuable one.
It's really making me think about my financial priorities, that's for sure.
I think that's a good thing.
Yeah.
It's a shift in perspective that
Yeah.
can be really empowering. Now, when it comes to life assurance, there are different types to consider. Redhead starts with term assurance,
Term assurance. Okay.
which is basically life insurance for a specific period.
Okay. So is that like when you buy travel insurance for a vacation,
Exactly.
it only covers you for that specific trip?
It's the same idea. You choose the term, the length of time you need the coverage for, and just like travel insurance, term assurance comes in different flavors.
Oh, okay. Like what?
Well, there's level term where the payout stays the same throughout the term.
Okay.
Then there's increasing term where the payout actually grows over time.
Okay.
And then decreasing term where it shrinks over time.
So you can like really customize it to fit your needs.
Exactly. You choose what you're looking to protect and for how long.
That makes sense. Now, Redhead also mentions renewable and convertible term assurance.
Yeah, those are some interesting options.
What are those all about?
So, renewable term assurance, that allows you to extend your coverage once the initial term ends
Okay.
without having to go through a new application process.
So you're not locked in, you have some flexibility.
Exactly. And then convertible term assurance.
Okay.
That lets you switch to a permanent life insurance policy later on.
So you don't have to make a lifelong commitment right away.
Exactly. You can adjust as your life changes.
That's good to know.
And here's the kicker. Both of these options, renewable and convertible, usually come with something called guaranteed insurability.
Guaranteed insurability.
What's that? It means you're guaranteed to be able to renew or convert your policy without having to go through more medical checks.
Wow, that's a big deal,
It is.
especially as you get older.
Exactly. It's like having a reservation at a popular restaurant.
Okay.
You're guaranteed a table, even if it's fully booked.
Like that. That's a good analogy.
Now, with all these different types of policies and payouts, I know what you're thinking.
What am I thinking?
How do insurance companies manage all this risk?
That's a good question, yeah.
Redhead mentioned something called asset liability management.
Asset liability management.
It sounds complicated, but it's actually pretty straightforward.
Okay, break it down for me.
So insurance companies, they have to balance the money coming in, the premiums, with the money they might have to pay out.
The claims, yeah.
Exactly. They have to make sure they have enough funds to cover those potential claims.
So it's like balancing a budget.
It is, but on a massive scale. Asset liability management is all about making sure the insurance company is financially stable.
Okay, so they can meet their obligations. That makes sense.
So we've covered the temporary safety net of term assurance, but now let's shift gears and explore permanent life coverage.
Permanent life coverage, okay.
We're talking about whole of life policies.
Whole of life, okay. That sounds pretty serious.
It is a big decision. With whole of life policies, you're covered for your entire life. hence the name.
So, unlike term assurance, which has a set time limit.
Exactly. A whole-of-life policy guarantees a payout to your beneficiaries whenever you pass away,
Yep.
no matter when that is.
So it's like a lifelong safety net.
It is. And because of that, they tend to be more expensive than term assurance.
I can imagine.
Mm.
But they also come with this feature called surrender value, right?
Yes.
What's surrender value?
So that means if you decide to cancel the policy before you pass away, you'll receive a cash value back.
Oh, okay.
The amount depends on how long the policy has been in effect and how much you've paid in. Have you ever thought about cashing out a life insurance policy?
I haven't really.
Okay.
But I guess I'd have to think about, why I got the policy in the first place.
Yeah.
And if my needs have changed.
Right. It's not a decision to take lightly.
It's a big one. Now, within whole-of-life policies, there are different options, like without profit and with profit policies.
Right. Those are the two main types.
What's different?
So without profit policies are generally invested in low-risk assets, things like bonds, offering guaranteed but potentially lower returns.
So it's like a savings account with a guaranteed interest rate.
That's a good way to think about it. With profit policies, on the other hand, invest in a wider range of assets.
Wider range. Yeah.
Including things like stocks and real estate.
Okay. So potentially higher returns, but also more risk.
Exactly. It all comes down to your risk appetite.
Makes sense. Redhead also mentions unit-linked whole-of-life policies.
Ah, yes. Those give you even more control.
Oh, how so?
Well, they allow you to pick specific investment funds for your premiums.
So I can tailor my investments to my specific goals.
Exactly. It's all about finding the right fit for your individual needs.
That's cool. Now, shifting gears again, Redhead also covers endowment policies.
Yeah, endowment policies are interesting.
They are a bit different from term and whole-of-life policies.
They are. They're like a hybrid between a savings plan and life assurance.
Okay, how so?
So they mature after a fixed period, say 10 or 25 years. At that point, you receive a lump sum payment called the maturity benefit.
So you get a guaranteed payout at the end of the term.
You got it. And if you pass away before the term ends, your beneficiaries receive the sum assured or the current value of the investment fund, whichever is higher.
Interesting. But I have to admit, all these different policy types are starting to make my head spin a little.
It's a lot to take in, I know.
Yeah.
That's why we're taking it step by step. Now, before we dive into the specific investment options within life assurance, let's touch on a couple of other policy types Redhead mentions.
Okay.
Friendly society policies and investment bonds.
Okay, what are friendly society policies?
They're essentially a type of endowment policy, but with some tax benefits.
Oh, tax benefits, nice.
However, there's usually a limit on how much you can contribute.
Okay, and what about investment bonds? Are those just about investments, or is there a life assurance element too?
They do have a small life assurance component, but the primary focus is on investment growth. Think of them as a vehicle for growing your money over time. We'll delve deeper into investment bonds in the next part of our deep dive. They have some unique features and tax implications that are worth exploring.
Sounds good to me. But before we move on, maybe a quick recap of what we've covered so far.
Absolutely. We started by discussing the importance of understanding your human capital and how life assurance can protect it from risk.
Right, and we explored the differences between term assurance, whole-of-life policies, and endowment policies.
We also touched upon the concept of surrender value.
Right.
And how insurance companies use asset liability management to ensure their financial stability.
Wow, it's amazing how much we've already covered.
I know, right?
I'm definitely starting to see how all these pieces fit together.
It's like building a financial fortress brick by brick.
I like that.
Yeah.
Now, are you ready to delve into the fascinating world of investment options within life assurance?
Yeah.
Let's dive in.
Okay.
Okay, so we're back and ready to explore these investment options available within life assurance policies.
All right.
We touched on investment bonds earlier, remember?
Yeah.
The ones that are like a souped-up savings account
Right.
with a sprinkle of life assurance.
That's a great way to put it.
So it's not a one-size-fits-all approach, huh?
No, not at all.
You can pick and choose what works best for you. So what kind of investment options are typically available?
Well, you'll usually find a range of funds to choose from.
Yep.
Managed funds, general funds, fixed interest funds, specialist funds, just to name a few.
So it's like a buffet.
Think of it like a buffet of investment options.
I like that. A buffet for your money.
Exactly.
Can you break down those different fund types for me?
Sure.
What are the key differences?
All right, so managed funds, those are like the all-rounder option. They invest in a mix of assets.
Okay.
Shares, bonds, property, you name it. Aiming for a balance between risk and return.
So a little bit of everything.
Yeah, it's a diversified approach, like a well-balanced meal.
Makes sense. Good for people who want a taste of everything.
Exactly. Then you have general funds, which focus mainly on shares.
Okay, share, so a bit more risk involved there.
Yeah, they tend to be more volatile than managed funds, but also offer the potential for higher returns.
Higher risk, higher reward.
That's the general idea.
Now, what about fixed interest funds?
Fixed interest funds. Those are a bit more stable.
Yeah, they sound it.
They focus primarily on bonds.
Okay.
Bonds typically offer more stable returns than shares, but they may not keep pace with inflation over the long term.
Gotcha. So good for stability, maybe not so much for growth.
It depends on your goals and your time horizon.
All right, what about these specialist funds? They sound pretty interesting.
Yeah, specialist funds are where things get exciting.
Okay, I like exciting. Tell me more.
They target specific sectors or industries, maybe even geographic regions.
So like what, technology or healthcare?
Yeah, exactly. You could have funds specializing in technology, healthcare, emerging markets, or even ethical investments.
So if you want to align your investments with your values, that's the way to go.
Exactly. You can target your investments based on your interests or beliefs.
Redhead talks about the classic risk-return trade-off with these different fund types, right?
Always. It's the golden rule of investing.
So higher potential return usually means higher risk.
Exactly. Specialist funds, with their targeted approach, they offer exciting growth prospects.
But they also carry more risk.
Of course. Higher risk, higher reward.
Okay, so where do those other funds fall on that risk spectrum?
Well, general equity funds come next in terms of risk, followed by managed funds.
Yeah.
Then you have the lower risk options like fixed interest funds and money market funds.
So it's really all about finding that balance, right?
Finding the right balance for your individual circumstances and goals.
Now, Redhead's point about switching between funds within an investment bond really stood out to me.
Yeah, that's a great feature.
So you're not locked into one fund forever.
Not at all.
You can adapt as your life changes.
Most investment bonds offer that flexibility. You can switch between funds as your goals change or as your risk tolerance changes.
Okay, so what about taxes?
Yes, taxes.
You can't avoid them.
The tax man always wants his share.
So how are investment bonds taxed?
Okay, so here's the thing. With investment bonds, the fund itself pays capital gains tax on any profits made,
Okay.
even if you haven't personally withdrawn any money.
So even if I haven't actually realized any gains, I'm still indirectly paying taxes.
You are. It's a bit different from other investments like unit trusts.
Okay.
With those, you only pay capital gains tax when you sell the investment.
Okay, so I'm curious, are there any tax advantages to investment bonds then?
There can be, especially for higher rate taxpayers.
Oh, okay, how so?
Redhead explains a strategy called top slicing.
Top slicing.
Yeah, it allows you to withdraw up to 5% of your initial investment each year for up to 20 years without paying any immediate tax on those withdrawals.
Wait, so I can access part of my investment tax-free for 20 years?
That's the idea.
That sounds pretty good.
And the real benefit comes when the bond matures. You'll then pay income tax on the gains, but it's calculated using an averaging method.
Averaging method, okay.
So that can potentially reduce your overall tax liability,
That's interesting.
especially if you're in a lower tax bracket when the bond matures.
Like in retirement, for example.
Exactly. It's a way to potentially smooth out your tax burden over time.
That's pretty clever. Redhead also mentions these maximum investment plans, or MIPs.
Yes, MIPs.
Are those similar to investment bonds?
They share some similarities, but MIPs are designed for regular premium payments rather than a lump sum investment.
Okay, so a bit more structured.
They run for a fixed term, usually 10 years, and at the end you can either cash out or let the investment continue to grow.
Okay, interesting. Now let's move on to with-profits funds. Redhead describes them as a way to pool your investments with thousands of others
Right.
and basically participate in the market with, a bit of reduced risk. How does it actually work?
So imagine a group of people pooling their money together to buy a diverse basket of assets. Shares, bonds, property, the whole shebang.
Okay.
That's essentially what a with-profits fund does.
Spreading the risk, diversifying.
Exactly. Aiming for a smoother ride compared to direct stock market investing.
Okay. Redhead makes a point about the smoothing effect of with-profits funds. What is that exactly?
Well, smoothing is all about managing volatility. The fund manager will hold back some returns in good years,
Okay.
creating a reserve, and then use those reserves to top up payouts in years when the market's not doing so well.
So it's like a buffer.
Yeah, like a shock absorber for your investments.
That makes sense.
Yeah.
So even when the market's going crazy, my returns are more stable.
In theory, yes. The idea is to give you a more consistent return profile.
Okay. So less stress, less worry.
Hopefully.
So Redhead talks about bonuses being paid out on these with-profit funds.
Yes.
What's the deal with those?
So you have two types: annual or reversionary bonuses and terminal bonuses.
Okay, what's the difference?
Annual bonuses are added to your policy each year.
Okay.
And once they're added, they're guaranteed.
Oh, okay. So I can't lose those.
Exactly. It's like getting a guaranteed raise on your investment every year.
I like that. What about terminal bonuses?
Terminal bonuses are paid out when the policy matures. It's like the grand finale of your investment journey.
So potentially a big payout at the end.
It can be. The size of the terminal bonus depends on the fund's performance, but it's a nice way to potentially boost your overall returns.
I see, okay. Now, Redhead also mentions orphan funds.
Ah, yes, orphan funds.
What are those all about? Sounds a bit mysterious.
They are a bit of a mystery to some people. Essentially, they're reserves built up within with-profits funds.
Okay, reserves, so like extra money.
Yeah, they come from various sources, including unclaimed policies, excess returns, and even profits from other parts of the insurance company's business.
So like a safety net for the fund itself.
Exactly. They add to the stability of the fund.
Makes sense. Now, smoothing and bonus payments sound great and all, but is there a trade-off?
There's always a trade-off.
Okay, what is it?
Well, by smoothing out returns and offering guarantees, with profits, funds might sacrifice some of the potential for high returns.
You mean like I might not get as much growth as I would if I invested directly in the stock market?
That's possible. It's like opting for a comfortable sedan instead of a flashy sports car. You get a smoother ride, but you might not reach top speeds.
Right, so it's all about priorities.
Exactly.
If I want stability and guarantees, with profits funds might be a good fit.
They could be.
But if I'm looking for the highest possible returns, maybe not so much.
Right. It's all about finding what aligns with your needs and your risk tolerance.
Makes sense. Now, what about these market value adjustments that Redhead mentions?
Ah, yes. Market value adjustments.
They can be a bit controversial.
They can. Essentially, they're adjustments made to the value of your policy to reflect changes in the market value of the underlying assets.
Okay, that makes sense. But Redhead suggests that these adjustments aren't always transparent.
You're right to be cautious. Transparency is crucial in any financial product, and with profits, policies haven't always been the best in that regard.
It's a bit concerning.
It's important to carefully scrutinize the terms and conditions of your policy.
And ask questions.
Absolutely. If anything seems unclear, don't hesitate to ask for clarification.
Knowledge is power, right?
Exactly. The more you understand, the better decisions you can make.
Now, speaking of informed decisions, Redhead emphasizes the importance of assessing the financial strength of the provider.
It's absolutely crucial.
Why is that so important?
You want to be confident that the company you're entrusting your money with is financially sound.
Right. I want to know they can pay out on those policies.
Exactly. You want a company that's stable and secure. Like choosing a bank, you don't want one that's teetering on the brink.
Makes sense.
Yeah.
So how do we actually gauge the financial strength of these providers? What should we be looking at?
Well, there are a few key metrics and considerations.
All right, so we're back. And I think it's time to really dig into this whole idea of assessing the financial strength of life assurance providers.
Yeah, it's really important. We can get all excited about the policies and the funds.
All the different options.
Yeah, but at the end of the day, it all comes down to trusting the company that's managing your money.
Exactly.
Absolutely.
It's like, I don't know, choosing a contractor to build your house.
Yeah.
You want to make sure they're reputable.
Right. You want a solid foundation. You want to make sure they're not going to cut corners.
Exactly. You don't want the whole thing to fall apart.
Exactly.
So how do we actually evaluate these providers?
Well, there are a few things to consider.
Okay, like what?
Redhead mentions the free asset ratio,
Okay.
but he also points out that it might not be the most reliable measure anymore.
Oh, really? Why is that?
Well, the free asset ratio basically looked at the percentage of assets a company held that were free and clear, after covering all its liabilities.
So like their safety cushion.
Exactly.
Right.
But it didn't always give you the full picture.
How so?
Well, a company could have a high free asset ratio just because they were being overly cautious, maybe holding back on bonus payments,
Right.
not necessarily because they were in a super strong financial position.
So it was a bit misleading.
It could be. Yeah.
So what do we look at now then?
Well, thankfully, things have evolved.
Okay.
The Financial Services Authority, the FSA,
Right, the FSA.
they now require providers to use a more comprehensive measure.
Okay.
It's called the realistic balance sheet.
The realistic balance sheet.
Yeah, it's a more sophisticated approach.
Okay, so it takes more things into account.
Exactly. It looks at potential risks, future liabilities.
Okay.
It aims to give a more accurate picture of the company's financial health.
So it's like getting a full medical checkup
Yeah.
rather than just checking your temperature.
Right. It's
Good
much
enough.
more thorough.
I like that. Okay, so Red Hat also talks about this idea of excess realistic assets.
Yes. Excess realistic assets.
What are those?
Well, think of it this way. It's the assets a company holds that are truly surplus.
Okay, surplus to requirements.
Right above and beyond what they need to meet their current and future obligations.
So like extra cushion?
Exactly. It's a key indicator of financial strength.
So the bigger the better.
Right. You got a healthy level of excess realistic assets means the company is in a strong position
Yep.
to weather any storms, unexpected events, economic downturns, whatever may come their way.
It's like having a rainy day fund
Exactly.
for the company itself.
Yeah, right. It gives you that reassurance that they can handle tough times without having to compromise on their policies.
Right, that makes a lot of sense.
Mm.
Now, Red Hat also mentions this thing called the risk capital margin.
Yeah, the risk capital margin.
What is that, and how does it relate to all of this?
So the risk capital margin is a regulatory requirement. It's basically a minimum amount of capital that life assurance companies have to hold in reserve.
Okay, to cover potential losses.
Exactly, on their investments.
Okay,
And the size of this margin depends on how risky their investments are.
right. So if they're investing in riskier things, they need a bigger margin
Exactly.
to protect against potential losses.
It's all about finding that balance between prudence and progress.
Right. You don't want to stifle innovation, but you also want to protect people's money.
Exactly.
So I remember how Red Hat brought up some criticisms of those with-profit policies,
Yeah.
saying that the term with profits might actually be a little bit misleading.
Yeah, it's a valid point.
Right, because it makes it sound like policyholders are sharing in the profits of the entire company.
Right, across all its different operations.
But that's not always the case, is it?
Not necessarily. Oftentimes, the profits that are shared come mainly from the with profits fund itself,
Oh, okay.
not from the company's other activities.
So it's important to really understand where those profits are coming from.
Absolutely, transparency is key.
Yeah, and Red Hat also brought up some concerns about the lack of transparency with some of those funds.
Yeah, there's definitely room for improvement in that area.
Right, like how are those investment decisions being made?
Right.
How are those smoothing adjustments calculated?
It's important for people to have a clear understanding of what's going on.
Exactly, because the more informed we are, the better decisions we can make.
Absolutely. It's about empowering consumers.
Okay, well, I think we've covered a lot of ground today.
We have.
We really went deep into life assurance and investment,
We did.
starting with human capital,
Right, for the very beginning.
talking about all the different policy types,
All the different options.
and of course, how to assess the financial strength of those providers.
Absolutely.
So hopefully everyone listening feels a little bit more equipped to navigate this world.
Yeah, it's a complex world out there.
It can be a bit overwhelming,
It can be.
but knowledge is power, right?
Exactly.
And this deep dive is just the beginning.
The first step.
So keep learning, keep researching, and definitely seek out expert advice
Absolutely.
when making those big financial decisions,
It's worth it.
because the best investment you can make is in your own financial literacy.
Couldn't agree more.
All right, that's it for our deep dive today. Thanks for joining us.
Thanks for having me.
We'll see you next time.